In the world of smart money trading, order blocks are one of the most powerful tools to understand the market's intent, but only if you know how to use them correctly. In today's video, we are diving deep into bearish and bullish order blocks, how to validate them, when they are most reliable, and how to combine them with key level and market timing to sharpen your edge in the market. This is IT Trades, where we trade smarter and grow smarter. So what are order blocks? Another block is a price level where institutions, banks and big players place large orders. So when price come back to these levels, you will see volatility, you will see a displacement, an aggressive move away from these other blocks. These other blocks they often act as reversal levels or strong continuation area because smart money use them to build position and trap retail traders. And there are two types of order blocks, which are the bullish order block and the bearish order block. Bullish order blocks, which usually appear before a strong upward move, and bearish order blocks, they usually appear before a strong downward move. But not all order blocks are valid. To avoid false signal, you need validation, and here is the key. A bullish order block is valid only when a candle of the opposite direction closes above the high of the candle and not just a wick. The close must happen with the candle's body. That is your confirmation. For bearish order blocks, it's exactly the opposite. You need a close below the low, again with the body of a candle, not just the wick. These rules filter out noise and improve your accuracy. Now let's talk about the key levels. Order blocks are most powerful when they align with liquidity levels. Always pay attention to session high and lows, especially London and New York session. Previous days high and low, previous weeks high and low, and previous months high and low. Then there is also a fair value gap, that is an imbalance where price turns to return. Also note the rejection block, an area where price tends to push but got rejected hard. When any of these levels align with another block, they are like magnets for price. And also the power of timing. Timing is very important in trading. Timing is everything in trading. The London Open and the New York Open are the two most volatile times in the Forex market. This section provides liquidity and momentum, the perfect environment for other blocks to play out. Watch how price reacts to key level during these opens. Most breakouts, stop hunts, and fake moves happen here. And that's when the smart money makes their move. You also need to note your drawn liquidity. So how do you know where price is likely to move to? By studying drawn liquidity. The market moves towards liquidity, not just random. That means the highs and lows we talked about earlier, the section highs and lows, the previous day's highs and lows, and the previous month's highs and lows, and so on are often targeted. Add fair value gaps, rejection blocks, and of course, the other blocks themselves. They also act as magnets to price, and you begin to see a pattern. Price is not random, it's engineered. Price is not random, it is engineered to grab liquidity before reversing or continuing. So putting it all together, use order blocks to spot where institutions are active. Validate with proper candle body close above or below the order block. Anchor your trade to key levels, session high, session lows, previous day's highs and lows, fair value gaps, and rejection blocks. Trade during high volume section like London and New York opens. Always follow the drawn liquidity, where price is mostly likely headed to. When you combine all of these, you are not guessing, you are reading the tension of smart money. If this video brought any clarity to your trading, don't forget to like, subscribe, and comment below. Let us know what strategy you want us to break down.